Hello, and welcome to this week's show. Thanks so much for joining us today. I'm your host, Trey Winowitz, and you're watching Right on the Money. Our goal for the show is to always equip you, the viewer, with accurate financial information so that you can make educated decisions for both you and your family. We've got a great show lined up for you today, so thanks for watching. We're going to be tackling some difficult financial questions, and we want to take some things that could be somewhat complicated and make them simple and easy to understand. So come on in and have some fun with us.
In the aftermath of Hurricane Katrina, Trey Winowitz was forced to move himself and his family over 600 miles north and begin his financial planning practice again, from scratch. Since then, Winowitz Financial has become a national success story, establishing itself as a trusted source for financial advice in and around East Tennessee. In return, Trey gives back to the community by sponsoring monthly educational workshops and annual charity events. He also hosts a weekly radio show informing and entertaining those in need of financial advice. So, if you'd like to understand more about today's challenging financial environment, if you'd like to overcome your current financial situation, and want to learn from someone with a track record of overcoming, stay tuned for some trusted financial advice that's right on the money.
Now let's get back to today's main topic, choosing the right advisor. One of the most common questions that I get asked by clients, friends, and even my relatives is what makes you or your firm any different from the broker that I've already been working with. Honestly, I think that's a great question. So good that I'll be spending most of the show explaining the differences between myself and other types of advisors out there, so you can choose which one's best for you and your financial interest. And here's what else we'll cover on today's show. Is your financial advisor an asset gatherer or a real financial manager? Could your advisor have a conflict of interest? Is your advisor required to serve in your best interest? And how fees can hurt a small investor? First, I'd like to take a look at a recent article from Motley Fool. I pity the fool. Not Mr. T. Fool. The Motley Fool. For our viewers out there, the Motley Fool is a website where you can read about some of the latest news on investing. The article I'll be looking at today discusses how a retail brokerage firm is different from a fiduciary advisory model. And the author is investigating one of the most popular advisory firms out there, one that serves over 7 million people. It says right here in the article, we set out to explore one central guiding question. Is a broker-dealer like this, regardless of its intentions, capable of putting the interest of their clients first? Now, this whole debate's been going on for a long time, and in my opinion, it's being discussed more and more these days because of the stock market's volatility as well as lower interest rates in banks and credit unions. But in order to understand the debate, let me define a couple of terms for you first. In a nutshell, a retail brokerage firm is one where financial advisors provide advice to customers in return for commissions, fees, or other payments that result from a financial transaction. On the other hand is a fiduciary model. That's what I do. Working under a registered investment advisor, I'm held to a higher standard. This is all laid out in the U.S. Investment Advisors Act of 1940. This standard requires me to act and serve in the client's best interest and to eliminate or at least expose all potential conflicts of interest. And when we come back, we'll look at some more excerpts from this very informative article about investment advisors. I hope you can stick with us. This is going to be a great show. Stay tuned for more trusted advice that's right on the money.
For the last few years, it's been harder to make a consistent return on your money. Are you paying too many fees? Could you get cheaper life insurance rates? Could you pay less taxes? Join the hundreds of others that have dramatically saved money using a free fee analysis. That means you've got to make sure your money is working efficiently for you. Call Winowitz Financial today, 691-2433. That's 691-2433, and start saving money today.
Thanks so much for joining us. I'm Trey Winowitz, and you're watching Right on the Money. If you're just tuning in, we're talking about whether or not financial advisors have conflicts of interest when it comes to giving advice to today's investors. I'm quoting from an article on a financial website called The Motley Fool. It says in the article, in 2004, a highly regarded investment firm stumbled over allegations that they didn't disclose important conflicts of interest. The question of whether or not this model possesses too many conflicts of interest bedevils the company and much of the financial industry today. The firm agreed, without admitted to any wrongdoing, to a $75 million regulatory settlement with the SEC for allegedly failing to disclose that it received tens of millions of dollars from preferred mutual fund partners each year on top of the commissions and fees. Today, the company continues to receive revenue-sharing payments from its preferred mutual fund partners, but it provides a detailed disclosure of those payments on its website. The company earned $98.1 million in revenue payments from mutual funds and another $54.1 from insurance partners in 2011. It approximately made $4.6 billion over that same period. What this means is some companies out there are way more inclined to sell you certain mutual funds or investments, and according to this article, it's because some of those carriers and products pay them more to do so. In the article, the financial firm in question argues that this is actually beneficial to ordinary investors and offers counsel and guidance that's free. As long as the potential conflicts of interest are disclosed, according to the company, it's okay. But as a result of this research, the author of the article disagrees with this view, and personally so do I. He goes on to say, while we're great believers in disclosure, that's not enough protection for the ordinary investor, often seeing their investment returns diminished by high costs they don't always understand. Any model that incentivizes the sale of expensive mutual funds or annuities to investors with relatively small portfolios is flawed. Unfortunately, academic research in behavioral ethics is pretty clear when people have a vested interest in seeing a problem a certain way, they're no longer capable of objectivity. Now, what I want to do here on the show is make sure that you, the potential investor, have all the information to make sure that you understand the compensation model versus the advice you're being given with whoever you choose to work with. I help investors all the time by going through a very short fee analysis. This is where we discover and eliminate unwanted and unnecessary fees from all their accounts. Give us a call and maybe I can help you. We'll go to a commercial now, but when we come back, we'll explore whether your retirement funds are being managed or if your broker is just gathering assets. We'll see you in just a second.
Are you planning for retirement? Which path should you take? How can you avoid mistakes? What about a second opinion? Get sound advice for today's market. Make sure your future is secure. With principal protection, reasonable returns, simplicity and safety, call Winowitz Financial today to schedule your complimentary financial review at 865-691-2433.
Thanks again for joining us. I'm Trey Winowitz and you're watching Right on the Money. Today we've been talking about how to choose the right advisor, and my question for you is, how do you know if your advisor is actually managing your retirement or just selling you something and trying to gather money? Are they employed by you or the firm? Well, sometimes people I see, they don't really know. Hopefully there's full disclosure out there, but sometimes advisors make themselves out to be money managers when all they really do is pick out a few mutual funds, look at the Morningstar ratings, which by the way you could do yourself, and then they tell you that you're diversified and that all you need to do is stay the course and it's not a good time to change anything. Now, if you're watching the show today and you're already working with an actual money manager who watches and trades your accounts daily and you feel like they're doing well, that's great. I'm not talking to you. But what I would say is let's compare the fees and the performance to make sure that you're getting what you are paying for. Personally, if I have a client who wants to have some of his money in a place where it could earn a higher return and it's suitable, what I focus on is who can we hire as a manager who's proven to make consistent returns when the market is good and avoid corrections when the market is down. It's no wonder I see the same funds, high-fee annuities, and expensive life insurance from the same companies. I know they're in the business of making money because we are too, but I believe the investor should get some education on lower or no-cost alternatives also. I operate Winowitz Financial under a fiduciary model, which we prefer to do. I try to show you all the options that could work for you and let you decide what's best. Just consider a second. If you're going to a place that only gets paid to sell what they have in inventory, what do you think they're going to recommend? Wouldn't you rather work with someone who lays out all the cards on the table for you and lets you choose the best thing for you? What I want to do now is talk about fees and how to eliminate them. One of the biggest impacts that our clients see takes place when we save them money on their investment fees so their accounts can become more efficient. People don't know always what they're paying in fees, so let's take a look at an example of how much it can cost you not to know. $100,000 invested for 10 years at 8% returns at compound interest grows over $200,000. Now, most of the time I see an average of about 1.5% to 2% in annual fee savings. And here are some of the fees that many of you may be paying. Management fees, custodial fees, 12B1 fees, trading fees, transaction fees, and rider fees. And sometimes the list goes on. That same $100,000 investment at the same return only yields $185,000 with a 1.5% fee. That's over $30,000 to your bottom line. I don't know about you, but to me, in a world where it's harder to make a fair return, that's a lot of money. Now, what I like to do in my initial meetings with clients is to go through and help them understand the high fees that they may be being charged and what their accounts are costing them to own. That way they can weigh the performance against the earnings and see if they feel like they're getting their money's worth from their manager or advisor. Most of the time, we can help find more efficient places for your money. This allows you to get the same or a better return, and a lot of times do it with less risk. Give me a call at the office if you'd like to take a look at some of your accounts, and we'll see what we can come up with. The bottom line for today's show is this. As an investor, you always want to make sure that you're getting objective advice. Sometimes it may take a second opinion to figure that out. You want to examine the fees that you're paying and compare them to the results. If you'd like, give me a call and I'll help walk you through a fee analysis and double check that for you. You also want to look for no or low cost accounts that are efficient. Consistent returns win with little or no losses. Coming up after the break, we'll learn how people just like you have benefited from a no-cost second opinion. Don't miss our Money Matters segment.
Are you looking to recruit and retain great employees? Would you like to reduce your retirement plan cost? Now you can offer employees the opportunity to keep their retirement funds protected and growing. Separate yourself from your competition. Make a difference in the retirement of your employees with little to no additional cost to you and no change to your TPA, payroll, or existing 401k company. Call Winowitz Financial today to find out more about this exciting new product.
I don't know about you, but what's been going on in the U.S. economy, and especially Europe, scares me. There are too many things that we can't control affecting our investments. We have to do our best to educate ourselves about the best options out there to protect our nest egg. The best way to do that is to call Winowitz Financial and reserve a seat at their next free educational workshop. There's usually a waiting list for these, so call today to reserve your seat. 691-2433. That's 691-2433.
Now that we're back, I'd like to tell you about some real-life folks that you may can relate to. Because it never hurts to have an extra pair of objective eyes take a look at your situation and see what can be improved. Even if strategies that you're using can't be improved on, sometimes people say it's a huge comfort when I tell them that what they're doing is working well, or maybe they should continue on the same path. However, in some cases we discover that some of the products or strategies they thought worked in a certain way actually don't. And sometimes not getting a second opinion can be very costly. If you want to be a part of this Money Matters segment, please give us a call at the office for a complimentary review. As you'll see, everything's kept confidential, but your situation may help some of our other viewers secure their financial future. So give me a call and maybe your case will get picked for the show. I want to take a second to introduce you to some people who came into the office recently for a no obligation second opinion just to be sure. And these people were glad they did. So let's take a look at this week's case. Hey Jana, can you bring me my notes? Thanks. All right. Okay, our case study this week is a 75-year-old teacher who's retired and a 73-year-old manufacturing engineer. They're both from Powell, Tennessee. These folks came in after listening to our radio show and where we were talking about traditional diversification versus true diversification. So our main concerns, or their main concerns as they came into the office, were cost and fees. They weren't really sure how their current advisor, stockbroker, was getting paid or what they were paying him for that advice. They also had some low interest rate accounts, some CDs and other things that were renewing at very low rates, so they were concerned about that, making a reasonable return on those. And then also just principal protection. They were informed over the years that they had a real diversified and conservative portfolio. However, they had lost quite a bit of money the last time the market dropped, so they were looking for just some assurance that they were doing the right thing. What we did, our steps to success, kind of like with a lot of folks that come in, first we ran a fee analysis. We wanted to see, how much they were actually paying for the accounts that they had. Were they having accounts that were efficient, and were they doing what they wanted them to do? Secondly, we compared their goals and objectives for their money versus the accounts that they had. Did the accounts that they have match what they were trying to do with that money? And lastly, we shopped around for other secure, guaranteed alternatives to their CDs that continue to be able to keep their money liquid and available to them. Results were, after we looked over everything, we did a fee analysis, we identified that one of the annuity products that they had was actually a variable annuity. It was costing them about 3.5% per year in fees. They had no idea. So a lot of times that fee analysis is very, very beneficial. We were able to upgrade that account to something that was more suitable, that had no fees, and it was very, very safe, and just really did well in accomplishing their goals for that money. Other than that, we also realized that they really didn't have a lot of protection from stock market risk. They had some diversification, but basically their risk was just spread out. They didn't have anything that was helping them eliminate the risk for the market. So we were able to solve that and find some accounts that helped them achieve some consistent dividends and interest for their accounts. Lastly, we also repositioned some of their managed money or some of their stock market money to a new management firm who had a consistent track record of helping avoid losses when the market went down. So learning about this couple proves that sometimes the right second opinion can be well worth it. Give us a call today for a complimentary review, and if your scenario gets picked for the show, you're going to receive a Right on the Money prize pack. But most of all, we want to help you. Coming up next, another opportunity for you to be a part of the show. Post it on our Facebook, tweet us, or email us your financial questions, and stick around for the viewer mail section. Welcome back to Right on the Money. I'm your host, Trey Winowitz, and it's time for you, the viewer, to be an integral part of this show, Viewer Mail. This is the part of the show where you send us your questions about anything financial. In order to get your questions to me, you can post them on our Facebook page, tweet your question to me at TreyWTV, or email them to me at advice@TreyWTV. If your question happens to get answered for the show, you'll receive a Right on the Money prize pack just for your willingness to help out our other viewers. This package has a retail value of over $50, so please don't stop sending us those questions. Our first viewer mail question today is, my car insurance agent is trying to get me to buy life insurance to get a discount on my other policies. Is this a good idea? Now, every situation is different, but what I've seen personally is that when people come to the office with this question, we run them an independent quote with companies specializing in life insurance. When you do this and compare the cheaper prices of an independent quote, sometimes it could save you more money than the bundled discount from your current provider, but not always. Give me a call at the office and we'll run you the same quote, and then as always, you, the consumer, have all the information so you can make an educated decision. And our next question is, I'm 26 and recently married, and my wife and I are looking into purchasing our first home. Also, my best friend from college just got a job selling insurance. What kind of insurance do I need to buy, whole life or term? Now, that's a great question, and having learned a lot about insurance companies over the years, I'd say that it's a pretty common question in your situation. Insurance needs can only be determined after meeting with a qualified professional, but I can generalize based on the information you've given me. Probably just makes sense to look at some low-cost, guaranteed term insurance. And there's probably some other things that you could focus on at this stage of your life before looking at purchasing whole life insurance. As a matter of fact, give me a call at the office and I'll send you a free copy of our DVD about our life insurance show, detailing the different options just to help you. Thanks a lot for our Facebook post. The last question we have time for today is this. I'm 39 years old and my company matches up to 3% on my 401k. I was going to put in 6 to save more money. Is this a good idea? First of all, it's a great idea to put money into your company retirement plan, especially when they're giving you matching funds. Despite your age, whether you were 29 or 49, my advice would probably be the same. Fund the 401k up to the match, then look into start funding a Roth IRA. This is going to allow you to have some of your money accumulating on a tax-free basis. With our current financial situation, paying taxes now and looking into all the alternatives for after-tax money, I believe is a wise choice. There are many low-cost and no-fee options out there for accounts. Please give me a call if I could give you any help. Stick around after this short break for Right on the Street. See what some local people just like you think about the stock market and other financial topics. You may actually see someone that you know.
For the last few years, it's been harder to make a consistent return on your money. Are you paying too many fees? Could you get cheaper life insurance rates? Could you pay less taxes? Join the hundreds of others that have dramatically saved money using a free fee analysis. That means you've got to make sure your money is working efficiently for you. Call Winowitz Financial today, 691-2433. That's 691-2433, and start saving money today.
Are you planning for retirement? Which path should you take? How can you avoid mistakes? What about a second opinion? Get sound advice for today's market. Make sure your future is secure. With Principal Protection, reasonable returns, simplicity and safety, call Winowitz Financial today to schedule your complimentary financial review at 865-691-2433.
And we're back. This is Right on the Money, and I'm Trey Winowitz. See what some local people just like you think about the stock market and other financial topics. You may actually see someone that you know. Maurice, what's a bull market in relation to the stock market? What does that mean?
Bull market, just say, I don't really know.
Okay, concerning the stock market, what is a bull market?
When stocks are doing really well.
That's exactly right. When the stocks are doing very well, so conversely, a bear market would be when?
When they're not doing so well.
Right.
Bull market's when people are selling.
Okay.
Bull market is something that you,
Can you make money in a bear market?
Yeah, if you qualify.
Okay, if you qualify.
Yes.
Good. That make a bear market.
When people are buying.
Okay. Would you think a bull market was a good thing or a bad thing? How about that?
no bad thing.
Okay. If you're using a buy and hold strategy in the stock market, when would be a good time to sell?
Let's see. Maybe in the summer.
Okay.
Well, that's a hard question.
Bonds. Are bonds safe?
Yes,
Okay. Can you lose money in a bond?
sure. You can lose money in anything.
What is a bond? Do you know what a bond is?
When you love somebody and unrepeatedly, maybe.
I like that. My wife and I feel the same way.
Yes.
Do you think you can lose money in a bond?
Yeah.
I agree. Well, how much risk should someone take with their money?
I think it depends on your age.
Okay.
I think the younger you are, you're okay with taking more risk in the stock market because you have a better chance to make your money back.
And how much risk should someone take with their money?
Well, I think that depends on the person. Some people are a little more willing to gamble than others.
How much risk should people really take with their money?
None.
I like that answer.
Well, when they get to the age of old age.
Old age? Okay.
I think you're asking me a lot of questions. Maybe I shouldn't be answering these questions.
No, these are all great. And can I borrow $20?
I don't have $20.
Okay, thanks. And last question, can I borrow $20? No. Okay, man. All right. Thanks for joining us, man. And can I borrow $20?
Sure.
All right, thank you very much. That was awesome. One last question. You look like a very well-dressed and wealthy guy. Can I borrow $20?
$20?
Uh-huh. You got 20 bucks I could borrow? Come on, man. You got 20 bucks?
I don't have it then.
Okay, no problem, man. Hey, thanks for your time.
And we're back. This is Right on the Money, and I'm Trey Winowitz. We're just getting ready to wrap up the show, but before we go, I'd like to tell you about an old Louisiana tradition called lagniappe. Lagniappe means to give someone a little something extra, and the way that we want to do that here at Right on the Money is to brighten your day at the end of our show. So with that, here's a little lagniappe for you. So Einstein dies. He goes to heaven, only to be informed by the doorman that his living quarters aren't yet ready. I hope you don't mind waiting in the dormitory, says the doorman. We're very, very sorry, but the best we can do is to get you a room that you have to share with others. Now, Einstein agrees, hey, that's no problem. No need to make a fuss. The doorman leads him down the hall, and they enter, and he's introduced to all his present roommates. Now, let's see. Here's your first roommate, and he has an IQ of 180. Einstein says, man, that's wonderful. We can discuss mathematics. And here's your second roommate. His IQ is 150. Einstein says, man, that's wonderful too. We can discuss physics, science, and things like that. And this is your third roommate, Mr. Einstein. His IQ is 100. Well, that's wonderful. We can discuss the latest plays in the theater. Now, just then, another man moves out to capture Albert's hand and shake it. I'm your last roommate, Mr. Einstein, and I'm sorry, but my IQ is only 80. Albert smiles at him and looks back. He says, so, what do you think the stock market's going to do? And that, my friends, is a little lagniappe for today. I want to personally thank you for watching our show today. I hope you found our show helpful as well as a little bit entertaining. If there's anything at all I can help you with financially, please don't hesitate to call our office. And remember, any plan that we come up with will always have three main goals for your money. Safety first, or protection of your principal, is always number one. Making a reasonable return on your money in what some would consider an unreasonable market. And number three, keeping your plan simple and easy to understand. If that sounds like something you want, I know I can help you. Also, please keep the financial questions coming. We'll do our best to get them answered on the show. I'll see you next week at 3 o'clock for more trusted advice that's right on the money.